Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get right into it. Today, we're digging into a really fascinating investment strategy. One that says your biggest wins might just be hiding where nobody else is even bothering to look, in the world of stocks that trade for under 10 bucks. You ever get that feeling, you look at the market and it seems like all the big Wall Street players are just stampeding in the same direction, and the regular investor kind of gets left in the dust? Well, if you've ever felt that, you're definitely not alone. And the whole idea we're exploring today is that feeling, that sense of being on the outside, could actually be your greatest secret weapon. So here's the game plan for our deep dive today. First, we'll talk about the problem, Wall Street's herd mentality. Then, we're going to uncover the secret edge this creates for you, the individual investor. We'll figure out where to hunt for these overlooked stocks and what the three main types of treasure are. Then comes the reality check, the work that's required. And finally, we'll wrap up by asking the big question, is this really a path to profits for you?
Okay, let's kick things off with the big idea that this entire strategy is built on. It's all about understanding and taking advantage of the sometimes crazy but often predictable behavior of the market crowd.
So what is this herd instinct? Well, think of it like this. A piece of news hits, could be good, could be bad, and all of a sudden it's a mad dash. Everyone is either rushing for the exits or stampeding to get in. And this huge wave of emotion, of pure fear or greed, can push a stock's price way, way off from what the company is actually worth. It creates these huge swings. But the key thing to get is that this stampede isn't just random chaos. It creates patterns, and those patterns create opportunity. Now, this whole strategy we're breaking down today isn't something we just made up. It comes from this book, The Little Book of Big Profits from Small Stocks, written by Hilary Kramer. And she's the real deal, a veteran investor who spent decades on Wall Street at major firms like Morgan Stanley. She basically built her career on the very ideas we're about to get into. And look, this isn't some obscure theory. You've got folks like Matthew Valencia from The Economist saying this book was her personal recipe for making money. And that whole recipe really started with this incredible light bulb moment she had during one of the most chaotic days in stock market history. So, how do you go from chaos to a coherent strategy? Well, every great idea has an origin story. And this one was literally forged in the fire of a massive market crash. I want you to just picture this for a second. The year is 1987. Hilary Kramer is a young analyst at Morgan Stanley, and the market is in an absolute, terrifying freefall. We're talking phones ringing off the hook, sell orders flooding the system, just pure, raw panic in the air. This was the herd mentality on full display, and it was ugly. So check this out. On October 19th, Black Monday, everyone is selling. The herd is stampeding for the exits, total panic. But the very next day, October 20th, while pretty much everyone else was frozen in fear, what did Kramer do? She did the exact opposite. She waded into the chaos and started buying solid companies that had just been completely hammered by the panic. And the result? By the end of that same year, those bargain basement stocks had already turned, as she puts it, a very nice profit. And that was the big lesson. The herd doesn't just create chaos, it creates these incredible windows of opportunity. It takes perfectly good companies and pushes their stock prices to ridiculously low levels, all based on fear. The secret she unlocked that day was so simple, but so powerful. When the herd is sprinting in one direction, you can often find amazing profits by just calmly walking the other way. Okay, so if you're going to go against the crowd, where do you even start looking? And this brings us right to the heart of the whole strategy. Focusing on a very specific, and let's be honest, often looked down upon part of the market, stocks that are trading for under $10. This right here really shows the disconnect. To the big Wall Street institutions, the under $10 space is a graveyard. A lot of the huge funds, the pension funds, they have rules in their charters that literally forbid them from buying these stocks. And the analysts, they mostly ignore them because there isn't enough trading volume to make it worth their time. But for you, the individual investor, all of that neglect, well, that's a golden opportunity. It means less competition, fewer eyeballs, and a real shot at finding hidden gems before the rest of the world even knows they exist. Seriously, think about that for a minute. While all of the big money, the hedge funds, the mutual funds, are all fighting over the same couple dozen big-name stocks, you get this entire field of potential opportunities pretty much all to yourself. It's a real advantage, one that's built right into the structure of the market. All right, so you're ready to go hunting in this overlooked territory. What exactly does the treasure look like? Well, Kramer breaks it all down into three very distinct, very powerful categories of stocks to look for. First up, you've got what she calls fallen angels.
Now, these are not tiny, unknown companies. We're talking about big, established companies, maybe even household names that have just stumbled. Maybe they had a terrible product launch, or a new CEO made a couple of boneheaded moves, and Wall Street has just crushed them for it. The herd panics and sells the stock down into the single digits. Your job is to figure out if this is a temporary problem or a fatal one. Is the brand still strong? Are their core assets still valuable? You're looking for a great company that's just having a really bad year.
Next, we have the undiscovered growth stocks. Now, these are the hidden champions in industries that Wall Street thinks are totally boring. Things like waste disposal, junkyards, companies that make some obscure but essential industrial part. Because they're not flashy, they just fly completely under the radar. But what you're looking for here is a company that is quietly, consistently making money and growing. They might not be exciting, but they might be steadily growing their revenue year after year, dominating their little niche. Your job is to find these quiet winners before the rest of the market finally wakes up.
And finally, my personal favorite, the bargain bin. This is pure old-school value investing. And the idea is just beautifully simple. You're looking for a company whose stock is selling for less than the actual value of all the stuff it owns. The analogy in the book is perfect. It's like finding a wallet on the ground, paying 80 cents for it, and then you open it up and there's a dollar bill inside. You'd make that trade all day long, right? Well, that's a bargain bin stock. You're literally trying to buy a dollar's worth of company assets for 50, 60, or 70 cents.
Now, finding these fallen angels and bargain bin deals, it sounds incredible. But, and this is a really big but, it is not a get-rich-quick scheme. This brings us to a super important reality check. This is not passive investing. This is active, hands-on, roll-up-your-sleeves kind of work.
And the book is super upfront about this. It pretty much draws a line in the sand. If you are the kind of person who genuinely loves digging into a company, reading the reports, and spending your weekend with the business section because you find it fun, this might just be for you. But if that sounds like absolute torture, or if you just want to buy an index fund and forget about it, this is probably not your cup of tea. It absolutely requires dedicated work. So, after going through the whole thing, the problem, the secret edge, the treasures, the hard work, what's the final, big picture takeaway here? It really just boils down to these four things. Number one, you have to believe that the herd's emotions create opportunities. Number two, you gotta hunt where the big guys can't. Use your size as an advantage. 3, you need to know what you're looking for, those fallen angels, the undiscovered growth stocks, and the bargain bin deals. And number 4, and maybe most importantly, you have to be willing to do the homework. And that really leaves us with the final, most important question of all. It's the one you have to ask yourself. It's not just about doing the research. It's about having the guts to trust it. When everyone else on Wall Street is screaming sell on a stock you believe in, do you have the conviction to stand your ground and maybe even buy more? Because that is the ultimate test of this whole strategy.
When you think about making a huge profit in the stock market, you probably picture some big, flashy company that's always in the news. But what if I told you the biggest opportunities aren't on the front page at all? What if they're actually hiding in plain sight, trading for less than the price of your lunch? Today, we're diving into the world of the classic under $10 stock.
And this quote, it just says it all, doesn't it? It perfectly sets the stage for the story we're about to tell. We're going to look at a company called Darling International, which is the perfect case study for how a business that most people would, literally turn their noses up at could end up producing some absolutely beautiful returns.
So here's how we're going to break it down. First, we'll get to know the Darling story. Then we'll see how the 2008 crash created this incredible once-in-a-lifetime opportunity. We'll watch its amazing 300% turnaround, and from there, we'll pull out a formula you can use to spot these kinds of stocks yourself. And finally, we'll tackle the most important question of all. How do you tell a real breakout opportunity from a company that's just, broken?
Okay, let's get right into it and meet the company at the heart of our story today, Darling International.
So, what did Darling actually do? Well, let me tell you, it was not a glamorous business. Not at all. These were the guys going around to restaurants and collecting all the used cooking oil and grease. They'd pick up animal byproducts, you get the picture. They took all this messy, unusable stuff and figured out how to turn it into valuable products. It's a tough, dirty job, for sure, but as we're about to see, it was a very, very profitable one. Okay, so this brings us to the absolute chaos of the 2008 financial crisis. I mean, panic was everywhere. Wall Street was in a free fall, and investors were just dumping everything they owned. But that very chaos, it created a massive opportunity for a company like Darling.
Just get a load of this timeline. At the beginning of 2008, Darling was a totally respectable $16 stock. But by November, deep in the crash, it had been absolutely crushed, bottoming out around $4. And Wall Street, which, let's be honest, never really cared about a stinky business to begin with, was now completely ignoring it. And right there, for a smart investor, that's the perfect time to start paying attention.
So you have to ask, right? What was the entire market missing? How could the stock be collapsing like that when the business itself was actually still chugging along? Let's dig in a little deeper. Well, the thing is, this company had a really powerful foundation that the market was just totally ignoring in the panic. Darling was the only national player in this field. That gave him a huge advantage over all the small, local guys. They were constantly growing by just buying up these smaller competitors, and they had locked in all their raw materials with long-term contracts. This was not a weak company, not by a long shot.
And these numbers, they really paint a picture of just how big their advantage was. This was a massive operation. 39 facilities, almost 1,000 trucks on the road, and over 115,000 collection points. I mean, that kind of infrastructure is just incredibly difficult and expensive for anyone else to even think about copying.
And the financial picture? Oh, it was even more impressive. In the few years right before the crash, their revenues nearly doubled. And their net profits? They more than doubled. This was a healthy, growing, and seriously profitable business that the market was suddenly treating like it was about to go bankrupt.
And here's the real kicker. Even in 2008, the year of the big crash, the business itself wasn't crashing at all. In just the first 6 months, its earnings were already about to beat the entire previous year. So the stock price was telling one story, but the company's actual performance was telling a completely different and much, much better one.
Okay, so this is where it gets really good. This is what leads us to that incredible turnaround. Because hidden just beneath the surface of this boring old company, there was a catalyst, a secret ingredient that was about to change everything.
And here it is. This was the hidden catalyst. While Wall Street just saw an old-school waste collection business, Darling was quietly getting ready for the future. They were planning to move into alternative energy by turning all that collected grease into biofuel. So this wasn't just a stinky business anymore, it was basically a green energy company in disguise.
And then, the spark. In September of 2009, Darling made it official. They announced a massive joint venture with Valero, a huge player in the oil industry. And that was the moment. That was the moment the market just couldn't ignore what was happening anymore. And the result was just spectacular. From that bottom near $4 in late 2008, the stock began this relentless climb. It doubled, then it blew past $10, and by the middle of 2011, it was right back where it started before the whole crash even happened. Just an absolutely incredible recovery.
So for the investors who looked past the panic, who saw the real value and that hidden catalyst, what was the return? Over 300% in just a little over 2 years. A phenomenal, phenomenal win from a stock that everyone else had literally thrown in the trash. So why did everybody miss this? Well, it really boils down to a few simple things. The business was just misunderstood. It was in an unpopular, stinky industry, so nobody was really looking at it that closely. And the few analysts who were looking were so obsessed with the short-term recession that they completely missed the huge, game-changing catalyst that was right there on the horizon.
Okay, so the Darling story is incredible, right? But how do we turn that one great story into a strategy we can use again and again? Well, that's where the breakout stock formula comes in. It's a framework for finding your own hidden gems.
So what exactly is a breakout stock? Well, think of it this way. It's a low-price stock that has all the ingredients it needs to shoot way, way higher. It just hasn't happened yet. The whole point is to find them before they pop up on everyone else's radar. And you know, they can come in a few different flavors. You've got companies like Darling, where a great business gets unfairly punished in a market panic. You also have companies that are pulling off these incredible internal turnarounds. Or you might find brand new companies with amazing potential that just nobody's discovered yet.
But no matter what type they are, all true breakout stocks have 3 things in common. Number 1, they're low-priced, usually under $10. 2, they're undervalued, meaning the stock price is way cheaper than what the business is actually worth. And 3, and this is the absolute key, they have a specific catalyst coming soon that's going to force the market to wake up and realize its mistake.
But this all leads to the most important question you have to ask yourself. Because let's face it, not every cheap stock is a bargain. In fact, most of them are cheap for a very good reason. You have to be able to tell the difference. Is this a true breakout stock, or is it just plain broken?
And that distinction, it's everything. A breakout stock is an undervalued opportunity that has a future catalyst. A broken stock is just a cheap value trap with a business that's permanently damaged. One is like a coiled spring ready to rocket up. The other is like a mousetrap that's just going to cost you money. Knowing which one you're looking at is the entire game.
So we're left with this thought. The story of Darling proves that these incredible opportunities are often found in the places nobody else is looking. It's not about finding something glamorous. It's about finding real value and a powerful catalyst. Which really makes you wonder, what unloved, under-the-radar, stinky business out there right now might be the next big winner, just hiding in plain sight?
Welcome to The Explainer. Today, we're diving into a market secret that pretty much goes against everything you've ever been told. We're talking about those cheap stocks, the ones Wall Street always warns you about. We're going to find out how they might just hold the key to some really explosive profits. Everything we're talking about today comes straight from the insights in the book chapter, The Price is Not Just Right, It's Critical. So yeah, let's get right into it. Okay, so let's start by tackling the official story. I mean, if you've ever talked to a broker or even just watched the financial news, you've heard the message loud and clear about stocks that trade for just a few bucks a share, right? The message is, they're dangerous, stay away, don't even think about it. But what's really going on behind this big universal warning?
It's pretty wild to think that this quote from President McKinley from way over a century ago just perfectly nails the modern Wall Street mindset. The word cheap isn't seen as a good thing, like a value or an opportunity. No, it's linked with failure, with massive risk, with, despair. And that belief, it's so deeply ingrained, it completely shapes how the entire financial world looks at these low-priced stocks. Brokerage firms, they actually build walls around these stocks. They'll tell you they're just lottery tickets, basically saying any win is pure luck. They'll slap on higher commissions and make it way harder to borrow money to buy them. A lot of platforms will even flash these big, scary warnings at you if you try to buy a stock under $10, almost like they're trying to stop you from making a huge mistake. The message is just relentless. This is a bad part of town, and any idea of making big money here is just a fantasy. Well, here's the fundamental problem with that whole line of thinking. These warnings, they just treat all low-priced stocks like they're the same toxic sludge. They throw the hidden gems right into the same bucket as the companies that are genuinely falling apart. It's kind of like saying all food is bad for you because you put broccoli and a greasy fast food burger in the same category. By not bothering to separate the good from the bad, they come to a totally flawed conclusion. So let's get to the heart of the argument here. Comparing a low-priced stock to a high-priced one is like comparing apples and kumquats. Yeah, they're both stocks, sure, but the actual physics of how they move in the market are just fundamentally different. Right now, you might be thinking, hang on a second. A stock going from $5 to $7 is a 40% gain. A stock going from 50 to 70 is also a 40% gain. The math's the same, what's the big deal? And you're right, mathematically, that's spot on. But that idea just completely shatters in the real world, because on Wall Street, things are almost never equal. The actual mechanics behind those moves are worlds apart. And it all comes down to the most basic, most powerful rule in economics, supply and demand. Every single little tick you see in a stock's price is just the result of a battle between the number of shares out there for sale, that's the supply, and the number of people who want to buy them, that's the demand. This simple, unbreakable law is the engine that can create that explosive potential in these cheap stocks. Now, to make this idea totally crystal clear, let's walk through a little story, a tale of two banks. It's a hypothetical example, yeah, but it perfectly shows the real forces that are at play in the market every single day, and it really highlights the incredible power of demand. Okay, so on one side, you've got Wells Fargo, a financial giant, a behemoth, with $150 billion market value, trading around $30 a share. It's a name everyone knows. Then, on the other side, you have Popular. It's a much smaller regional bank, worth about $3 billion, with its stock trading at just $3. Just look at the massive difference in scale here, on every single line. Okay, so now picture this. A group of investors suddenly gets really excited about banks. They decide to invest exactly $10 million into each of these two stocks on the very same day. Let's see what happens. And here it is. This is the whole ball game. That $10 million buys about 333,000 shares of Wells Fargo.
For a stock that trades 37 million shares a day, that's less than 1% of its daily volume. It's a tiny little drop in a massive ocean. But for Popular, that same 10 million buys 3.3 million shares. That's almost 40% of its entire daily volume. See the difference? It's not a drop, it's a full-on tidal wave of demand. This image just perfectly illustrates it. For Wells Fargo, that buying pressure is barely a ripple. But for Popular, that huge wave of new demand is a massive chunk of the day's action. What does that do? It puts enormous, immediate pressure on the very limited supply of shares that are for sale, forcing the price to shoot upward just to find sellers for all these new buyers.
So this isn't just some fun theory we cooked up. Let's look at a real, dramatic, honest-to-goodness case study of how this exact supply and demand dynamic created an absolute fortune for investors who got it. It's time to talk about a biotech company called Dendreon.
So Dendreon had this amazing, revolutionary cancer drug called Prevenge. Back in 2007, investors were just ecstatic, and they pushed the stock over $20. But then, disaster strikes. The FDA delays approval, saying they need more data. And Wall Street, they panicked. Big institutions, regular folks, everyone ran for the exits. The stock just started a brutal collapse, and it ended up hitting a devastating low of just $2.60 during the financial crisis. I mean, just look at this wild ride. The company's entire value just evaporated, falling from over $3 billion down to less than $400 million. For almost everyone in the market, this was it. It was a catastrophe, a total failure. But for the few people who were willing to look a little closer, this was a massive opportunity, born directly from all of that fear and panic. So what was the big secret? The author did the homework that Wall Street just couldn't be bothered to do. He actually read the FDA reports and realized, wait a minute, they didn't kill the drug. They just asked for more proof that it worked. The science was still solid. So while everyone else was panic selling, he was calmly buying, building up a position with an average cost of less than $5 a share. He was betting on the science, not the street's sentiment. And then the catalyst hits. The new trials are a massive success, and the FDA gives its final, full-throated approval. Suddenly, all those Wall Street institutions that had sprinted away from the stock now desperately wanted back in, and they wanted in right now. Millions and millions of dollars in buy orders just flooded the market, completely overwhelming the tiny supply of available shares. The stock went absolutely parabolic, and the result? A mind-boggling 900% profit. So, what is the ultimate lesson here? What's the takeaway? The whole strategy is about understanding how the big institutions behave, and more importantly, anticipating it. It's about figuring out where that big money is going to go before it actually gets there. It's all about positioning yourself right in front of the herd. You see, on Wall Street, there's this incredibly powerful herd instinct. A lot of fund managers are more afraid of being the only one who misses a big rally than they are of being wrong along with everybody else. It's a fear of missing out, a classic FOMO. And this creates a really predictable pattern. They totally ignore stocks when they're cheap and beaten up, but then they all rush for the door, or through the entrance at the exact same time. And this is what creates that repeatable pattern that we can actually take advantage of. Step 1. Wall Street pushes a stock down into the gutter out of fear or just plain neglect. Step 2. You do the research they won't do, and you find that hidden value. Step 3. Some kind of positive news, a great earnings report, an FDA approval, whatever, proves that you were right. And that, my friends, is the dinner bell. The institutional herd stampedes in, the demand completely overwhelms the supply, and the stock price just takes off like a rocket. So, in the end, the very thing that makes Wall Street hate low-price stocks is what creates the opportunity. Their own internal rules, their biases, their herd mentality, that's what creates this inefficiency in the market. By pushing these stocks way too low because they're scared, they perfectly set the stage for these absolutely explosive comebacks when the story finally turns. So the only question you have to ask yourself is this: when that herd inevitably turns, are you going to be standing in front of it, ready to profit from the stampede? All right, today we're diving into one of the most dramatic, most fascinating corners of Wall Street. It's a place where corporate giants go to die. Seriously, it's littered with companies that used to be kings of their industry, but are now just completely left for dead. But hidden in all that wreckage are some of the most incredible comeback stories you've ever heard. Yeah, you heard me right. We're going hunting for fallen angels. So what exactly is a fallen angel? Well, the source material for this explainer uses this amazing metaphor from Dante's Inferno, and it is just perfect. Picture a company that was the absolute belle of the ball. You know the type, right? A respected blue chip, a high-flying growth stock, basically the kind of safe bet you'd tell your parents to buy. It was beautiful. But then something goes horribly wrong. The market's love turned into pure hatred, and now that same company is seen as a monstrous demon, something you wouldn't touch with a 10-foot pole. So here's the game plan for today. We're going to break this all down. First, we'll look at that journey from grace to disgrace. Then, and this is the important part, we'll get into the two crucial questions you have to ask. We'll see how they work with two incredible real-world stories, Ford and Priceline. After that, we'll get our hands dirty and talk about how you can actually start hunting for these things yourself. And finally, we'll talk about how to tell the real angels from the demons. So, how does this happen? How does a corporate superstar end up as a total pariah? And look, we're not just talking about a bad quarter here or some missed earnings. No. This is a total seismic shift in how the world sees a company, from being a leader to being a loser. So check this out, because what's so fascinating here is the psychology behind the fall. On the left, you've got the before picture. This was a widows and orphans stock. That's an old school term for a company so safe, so reliable, it was a no-brainer. But now, look at the after. The company is toxic. And here's where a really dangerous feedback loop kicks in when the stock price drops below $10 a share. See, a lot of these big conservative funds, they have these internal rules, right? And a common one is they literally cannot own a stock that trades below $10. So they become forced sellers. They dump the stock, which pushes the price down even more, which makes other people panic and sell, and pretty soon the whole herd is stampeding for the exits. Okay, so this brings us to the absolute heart of the strategy. It's so easy to get caught up in the fear and the drama, but smart investing here isn't about emotion at all. It's about using a cold, hard, analytical framework. And believe it or not, it all comes down to just two simple questions. First up, you gotta play detective. This is the diagnostic phase. You have to figure out the specific reason for this epic collapse. And vague ideas like, the economy is bad, just don't cut it. You've got to nail down exactly what and why things went so horribly wrong. And you know, the answer is usually hiding in one of these classic corporate blunders. Did the leadership get a little too arrogant and start buying up all sorts of random companies they had no business running, diversification? Or did they just take on way too much debt? Maybe a smarter, faster competitor just came along and ate their lunch. Or sometimes the world just changes and they didn't change with it. And then you have the really scary stuff. Are we talking about accounting scandals, big regulatory problems, a massive lawsuit that could sink the whole ship? You have to have a crystal clear answer here. Okay, so figuring out what's broken, that's only half the battle. The second question is even more important. Is the problem fatal, or is there a realistic way for this company to get healthy again? This right here is the million-dollar question. This is how you tell a company that's just tripped from one that's falling off a cliff. So what are you looking for? You're looking for a pulse, a credible plan to get back on their feet. If they got distracted buying other companies, can they sell that stuff off and get back to basics? If they have too much debt, is there a clear path to fix the balance sheet? And this last point is maybe the most important of all. Was it an honest-to-goodness mistake, or was it fraud? Because here's the thing. You can fix a bad business decision. You absolutely cannot fix fraud. One is a potential opportunity, the other is a guaranteed zero. All right, let's make this real. There's no better way to see this framework in action than with a company we all know, Ford. I mean, we're talking about an American icon, the definition of a blue-chip company. But in the mid-2000s, Ford drove itself right off a cliff.
So let's ask our first question. What on earth went wrong at Ford? Well, it was a textbook case of taking their eye off the ball. They went on this huge shopping spree buying up luxury brands like Jaguar and Volvo that had nothing to do with their main business. And by 2006, the bill came due, a mind-blowing $12.6 billion loss. The stock cratered. That's when new management came in and made a move that was, well, terrifyingly bold. They mortgaged the entire company, everything, right down to the blue oval logo, to borrow a mountain of cash. Then the 2008 financial crisis hit and the stock got annihilated, falling below $2 a share. Everyone thought Ford was toast.
I mean, look at that number, $23.6 billion. That's how much they borrowed. At the time, Wall Street was screaming. Analysts called it a desperate, insane gamble that would sink the company for good. But the new CEO, he saw it as a lifeline, a home improvement loan, he called it, to fix the business and get through a potential downturn. Little did he know, he wasn't preparing for a downturn. He was preparing for a meltdown. And this is where we get the answer to our second crucial question. Can it be fixed? Because when the 2008 crisis hit and the auto industry just stopped, Ford's biggest rivals, GM and Chrysler, they ran out of money. They went bankrupt. They needed massive government bailouts to survive. But Ford had that cash. That giant loan that everyone hated turned out to be the smartest move they ever made. It was their war chest. It let them dodge bankruptcy, fund their own turnaround, and win over a ton of public support while their competitors were on life support. And would you look at that? This chart just says it all, doesn't it? For the investors who ignored the panic, the ones who actually did their homework, they saw what went wrong, and they saw that Ford had the cash to fix it. So if you were one of the few who had the guts to buy Ford for under $2 when the world was ending, man, that was the play of a lifetime. It just proves that this fallen angel really did earn its wings back. Okay, so if Ford was a home run, this next story, Priceline, this is like a grand slam that left the stadium and is now orbiting Jupiter. It is the perfect example of just how ridiculously profitable finding a true fallen angel can be. I mean, just look at the sheer carnage here. At the height of the dot-com bubble, Priceline was a rock star, trading at $165 a share. Just a couple of years later, it was down over 99%. You could buy a share for less than $1. It was completely written off, a total joke. So again, what went wrong? Well, it was another classic case of a company getting way over its skis, fueled by dot-com insanity. Management thought their name-your-own-price thing was magic, so they tried to slap it on everything. Groceries, gas, even home mortgages. It was an absolute train wreck. They were just lighting cash on fire. But, and listen closely, because this is the key, their main business, the travel part, booking flights and hotels, it was still a fantastic business. The engine was good. It was just all the other junk they'd bolted onto it that was the problem. 70x. I mean, that's not a typo. We're talking about turning every $1,000 into 70,000. So let's run the play. What went wrong? They lost focus and expanded into a bunch of garbage businesses. Can it be fixed? You bet. All they had to do was shut down all that nonsense and focus on the one thing they were actually good at. They did, and the investors who saw that simple fix were rewarded with one of the most unbelievable stock market turnarounds in history. All right, these stories are amazing. I get it, but it's easy to look back and say, oh, I would have bought that, right? So let's get practical. How do you actually find these things in real time before everyone else catches on? Let's talk about how to build a watch list. And here's the cool part. You don't need some secret Wall Street decoder ring to do this. You just start by paying attention. When a huge, well-known company gets in trouble, it's all over the news. That's your first breadcrumb. A great old-school trick is to look at the financial papers and scan the 52-week low list. You're looking for names that just don't belong there. Big, powerful brands mixed in with all the junk. Or just scroll through the S&P 500 list and see which of those titans are trading in the single digits. And today, of course, you can use a free online stock screener to do this in like 5 seconds. Just look for big companies, say over $1 billion in value, that are trading under $10 a share. That'll give you a great starting list. So yeah, making a list of candidates, that's the easy part. The real work, the part that gives you an edge, starts right here. You have to go to the source. The answers you're looking for aren't in some hyped-up news article. They're in the company's official filings with the SEC, the quarterly 10Q and the big annual 10K. And yeah, they're dense, they can be kind of boring, but that's your edge. That's where the company legally has to tell you the truth. It's how you really, truly answer those two crucial questions. Okay, so we've covered the what, the why, and the how. But before we wrap this up, we have to have a serious talk about the dark side of all this. Because I have to be crystal clear about this. For every angel that gets its wings back, there's a demon waiting to drag your portfolio down to zero. Please listen to this. This is probably the single most important thing I'm going to say today. This is not a paint-by-numbers strategy. You can't just blindly buy every famous company that drops below $10. You just can't. As the source material makes painfully clear, Enron and WorldCom, two of the biggest corporate frauds in history, they both looked like fallen angels at one point. They were huge, they were respected, and their stocks crashed into the single digits. But their problem wasn't a fixable mistake. Their problem was that their entire business was a lie. But see, that's the beauty of this two-question framework. It's your filter. It's what helps you separate the companies that are just sick from the ones that are rotten to the core. The rewards here can be life-changing, but they are absolutely reserved for those who do the homework. So the toolkit is yours, the roadmap is in your hands. The only question left is, which fallen giant are you going to investigate first?
Hey everyone, and welcome. Today, we are going on a treasure hunt, a financial one. We're going to dive into one of the most exciting and, let's be honest, potentially profitable topics out there: how to find those explosive growth stocks in places nobody else is even thinking to look. I mean, it's the dream, right? That's what every investor is after, finding that one stock that can just completely transform your portfolio. The very idea of a growth stock makes you think of some revolutionary company with profits just shooting for the moon. And, for good reason. Getting in early on the right company can lead to some truly life-changing returns. So, here's the key question we're going to tackle. What if the real path to those huge gains isn't chasing the same hot tech stocks that everybody and their brother is talking about? What if the real opportunities are actually hiding in plain sight, just waiting for someone with a slightly different perspective to come along? And this quote just nails it. The legendary investor Sir John Templeton knew that if you're doing the exact same thing as the crowd, you're going to get the exact same results as the crowd. It's common sense, really. To find something exceptional, you have to be willing to look where other people aren't. Okay, so before we can start finding the right stocks, we need to get super clear on which ones to stay away from. So we're going to start with the companies that get all the media attention, the so-called Wall Street darlings. Now, this slide really lays it all out. Look at the contrast here. On the left, you've got the darlings. Think about a company like Apple. You hear about them everywhere, they've got the cool tech, tons of momentum, and everyone loves them. But what's the problem? Well, all that hype means they're often super expensive. A lot of that future growth is already priced right into the stock. But now, look at the right side. That's our hunting ground, the undiscovered gems. They're totally off the radar, maybe in a business that's kind of boring or even, disagreeable. And because they're overlooked, they're often cheap, with just massive potential to break out. And that leads us perfectly into our first core strategy: finding profits where nobody expects them, in businesses that are just utterly and completely unremarkable. This idea comes from another investing giant, Peter Lynch, and his logic was just brilliant. He argued that the absolute perfect stock would be a niche so dull that Wall Street analysts couldn't even be bothered to cover it. You've got no hype, no big institutions owning it, just a quiet, profitable little business making money hand over fist. And speaking of downright disagreeable, what could be more disagreeable than a business that literally stinks? Which brings us to a perfect case study, a company called Darling International. So here's the deal with Darling International. They're in the rendering business. That means they take animal byproducts and use cooking oil and recycle them into things like animal feed and biofuel. Yeah, it's messy, it's dull, and it's definitely not something you'd bring up at a dinner party. But that was its greatest strength, because no analysts were paying attention. The company just quietly grew and grew until it was the biggest player in its entire industry, with earnings expanding like crazy. It was the perfect undiscovered growth stock, hiding right there under everyone's noses. Okay, next up, this is a really fascinating angle: finding companies whose customers are less like customers and more like, well, fanatics. We're talking about businesses built on obsession, which can create a kind of demand that is basically bulletproof, even when the economy gets rough. This question sets up an incredible real-world story of how just paying attention can be all the complex Wall Street analysis in the world. So picture it: 2003, New York City, and the entire power grid goes down. Total blackout. Almost all communication is gone, but one little device kept on working. So back in early 2003, Research in Motion, the company that made the BlackBerry, was in deep trouble. Their stock was in the single digits, their old pager business was totally dying out, and they were stuck in all these lawsuits. But then, the blackout hit, and one investor in New York City realized his BlackBerry was the only thing that worked. He could communicate when literally no one else could. That personal, real-world observation showed him just how superior their technology was. As soon as the lights were back on, he started buying up the stock. And what happened next? The crackberry craze. It sent the stock soaring by more than 100 times over the next 5 years. Just incredible. All right, here's another question that gets right to the heart of this obsessive customer idea. During the 2008 financial meltdown, pretty much every retailer was getting absolutely crushed. But some hobbies, some lifestyles, they don't stop for a little thing like a global financial crisis. Let's look at Cabela's, the giant outdoor store back in 2008. Wall Street looked at it and saw just another retailer with a bunch of debt and a risky credit card business. So they hammered the stock, selling it all the way down below $5 a share. But the reality on the ground was completely different. See, Cabela's wasn't just a store. It was a lifestyle brand for obsessed hunters and fishermen. And check out the numbers. Wall Street was worried about debt, but the company actually had more cash than long-term debt. And that supposedly risky credit card business, their customers were so loyal, they just kept paying their bills. The percentage of debt they had to write off as a loss was under 3%. That was way, way below what other retailers were seeing. It was proof of just how dedicated their customers were. And this just hammers home the power of the strategy. By understanding that obsessive customer base, an investor could see what Wall Street was completely missing. The author of our source material started buying the stock under $5 and sold it less than a year later for a nearly 200% gain. It's such a powerful lesson in looking past the widespread panic and focusing on the reality of one specific business. Okay, so we've looked at the boring and the obsessive. For our third strategy, we don't have to look quite so far. Sometimes the biggest growth stories are hiding in plain sight, sitting right there in our own grocery carts. Let's talk about Dole Foods. They had their IPO, their initial public offering, back in 2009, right after the recession, and nobody cared. I mean, growth investors wanted sexy new tech stocks, not some boring old fruit and vegetable company. The stock just sat there. But here's what everyone was missing. Two huge, powerful global trends. First, a growing demand for healthier foods right here at home, and second, a rising middle class in emerging markets all over the world who wanted better, higher quality food. Dole was perfectly set up to cash in on both, and eventually the market figured it out and the stock shot up over 50% in less than a year.
So we've seen the theory, we've looked at the case studies. Now let's get practical. How can you actually go out and search for these undiscovered gems? Well, this next section is your treasure map. 2 specific stock screens you can use to start your hunt today.
All right, our first screen is for what we'll call the steady grower. These are companies with a really solid track record. First, you're looking for consistent earnings and revenue growth of at least 15% a year for the last 5 years. Solid. Next, we want a strong balance sheet, so we're looking for a debt-to-equity ratio of 0.3 or less. That just means they own a whole lot more than they owe. Then we cap the price at $10 to help us find those overlooked bargains. And finally, and this is a big one, insider ownership of at least 10%. That means the people running the company have their own money on the line. They have skin in the game, which is exactly what you want to see.
Now, our second screen is for the explosive grower. These are companies that are hitting a major turning point. Here, we're setting the bar for annual earnings growth way, way higher, at least 100%. This could be a company making a huge comeback or one that just launched a breakthrough product. We can be a little more relaxed on the debt, so the max debt to equity is 0.5. And again, we're fishing in that low price pond, so the stock price is $10 or under. This kind of screen can help you find companies just before they pop up on Wall Street's radar.
And you know what the best part is? You don't need any expensive professional software to do this. There are plenty of fantastic and totally free stock screeners online from all the major financial websites. You can literally go and plug in these exact criteria and start your hunt this afternoon. In fact, it's a good idea to use a couple of different ones because their data can sometimes be a little different, and you might find a gem on one that another one misses. So let's end with this one big idea. The true opportunities, the returns that can change your financial future, they often come from looking at what everyone else just dismisses. The boring, the misunderstood, the seemingly ordinary. The tools are out there. The strategies are clear. The only question left is, what are you going to find? You know that feeling when you're at a garage sale and you spot something you just know is worth way more than the price tag? That little thrill of finding a hidden gem? Well, today, we're going to take that exact same treasure hunting energy and point it straight at the stock market. We're going on a hunt for Wall Street's hidden treasures. So here's our game plan. First, we'll get into the treasure hunting mindset. Then, I'll show you the map you'll need to find these bargains. We're going to look at a couple of real-world examples of hidden gems. After that, I'll give you a super practical guide to start your own search. And we'll finish up with the biggest, most important idea to take away from all this.
All right, let's set the stage. The idea here is really, really simple, and it's something we all get. Everybody loves a good deal. Everybody loves buying something for way less than it's actually worth. I just love this story. I mean, think about it. A single dollar turns into $1,000. Why? Because somebody knew what they were looking at. They saw value that the seller was completely blind to. And that's not just luck, right? That's knowledge. And that's exactly what we're talking about today. So we're going to take that exact same principle and apply it to stocks. We're on the hunt for what our source material calls bargain bin stocks. These are companies that, for whatever reason, are selling on the stock market for less than the value of the actual stuff they own. They're basically Wall Street's version of that $1 book. But listen, you can't just stumble upon buried treasure. You need a map, and you've got to know how to read it. For us as investors, that map is a company's financial statements. So, the first big symbol on our map is something called book value. Now, don't let the name throw you off. It's actually super simple. Think of it like your own personal net worth. You just add up everything a company owns, that's its assets, and you subtract everything it owes, those are its liabilities. And boom, what's left over is the book value. Simple as that. Okay, now we're going to make our map even better. We're going to zero in on something called tangible book value. We take that book value we just calculated and we subtract anything that's, well, not tangible. Things like brand recognition or something called goodwill. Why do we do that? Because we want to know the value of the hard physical assets, the factories, the real estate, the stuff you could actually sell off in a pinch. This, my friends, is our true north. So you're probably thinking, okay, if these companies are so valuable, why on earth are they so cheap? And that's a great question. Usually it just comes down to emotion and the weird quirks of the market. Sometimes a company hits a rough patch and everyone panics, or an entire industry just falls out of fashion and everybody runs for the hills. Sometimes a company is just too small for the big Wall Street analysts to even bother with, or the market's just obsessed with this quarter's results, not the long-term value. Whatever the reason, it creates a window of opportunity. All right, let's look at a case study to see how this plays out in the real world. This is such a great example of an entire industry getting tossed in the bargain bin, which created a huge opportunity for anyone who was paying attention. Okay, I want you to picture it. The year is 2008. The economy is grinding to a halt. People are driving less, so demand for gas is just falling off a cliff. For oil refiners like this company, Tesoro, business was, well, it was awful. Their profits were getting squeezed, and investors were stampeding for the exit. But if you ignored the panic and looked under the hood, what was actually there? You'd find a mountain of real, tangible assets. Tesoro owned 7 giant refineries. It owned almost 900 gas stations. It owned 900 miles of oil pipelines. This is real stuff with real, lasting value. And here's the kicker. Those refineries weren't just valuable. They were practically irreplaceable. As our source points out, because of all the regulations and everything, a major new refinery hadn't been built in the US in over 30 years. That makes the ones that already exist way more precious than what the accounting books might even say. This chart just says it all. The market was selling shares of Tesoro for about $8, but the tangible book value, the actual value of its hard assets per share, was $23. Think about that. You could buy $1's worth of these irreplaceable assets for about 35 cents. It was a massive sale, and almost nobody was shopping. And this wasn't some fluke. The source shows us a clear, repeating pattern in this industry, using another company, Valero, from an earlier downturn. In 2003, the stock got hammered, but as the economy picked back up, it just exploded higher. It shows that for investors who are patient and understand these cycles, these downturns are not crises. They're predictable buying opportunities. Okay, so that was a whole industry nobody loved. Now let's switch gears and look at a different kind of opportunity. A single company that the market just totally misunderstood. After a big crash, investors get scared of anything and everything related to Wall Street itself. Investment banks, asset managers, you name it. And in the week of that 2008 crisis, a firm called Cowen Group was in that exact spot, totally abandoned, trading at a crazy discount. So here's the key. On the one hand, you have what the market saw, just another struggling investment bank. But on the other hand, you have what was really there, a collection of really valuable businesses, a strong asset management division, deep relationships in hot sectors like tech and healthcare, and a business that was perfectly set up for a big wave of mergers. I mean, when you really dug in, the strengths were obvious. They had these great hedge funds from a merger. They were led by Peter Cohen, an absolute legend in the industry. And because they had all these great pieces, the talent, the funds, the clients, the company itself became a really attractive target for a bigger bank to just buy them out. Another way for investors to win. All right, we've seen the theory, we've seen the real-world examples. Now for the fun part. How can you actually go out and find these potential bargains for yourself?
let's get into the screen and steal mission. Your number one tool, your metal detector for this treasure hunt, is a stock screener. And the great news is you can find them for free on pretty much any major finance website. It's a tool that lets you scan thousands and thousands of stocks to find the ones with the specific clues we're looking for. Okay, so here are the 4 simple criteria you can plug right in. First, price to book value of less than 1. That's our basic rule. We only want stocks trading for less than their worth. Second, a debt-to-equity ratio under 0.30. This is so important. It helps us avoid companies that are just drowning in debt. Third, a stock price under $10. This helps us focus on smaller, under-the-radar companies that can have explosive growth. And finally, a PE ratio that's greater than 1. All this does is make sure the company's actually profitable. That it's making money. So we've covered the what, the why, and the how. But I've got to tell you, the single most important part of all of this isn't a ratio or a number. It's about a fundamental shift in how you see the world.
This quote right here is everything. Most people see the market going down and they feel fear. The bargain hunter, though, they see a sale. They see an inventory creation event. It's a chance to buy incredible assets for even cheaper than before. It completely flips the script, turning volatility from a threat into your single biggest opportunity.
So I'm going to leave you with this one question. The next time the headlines are screaming about a market crash, how are you going to feel? Are you going to see a crisis to run away from? Or are you going to see the bargain bin being restocked, giving you a chance to go fill your shopping bag with treasure?
So, what if you could invest in companies that are not only saving lives but could also deliver absolutely life-changing returns? Well, that's exactly what we're diving into today, the world of biotech and pharma. It's a sector where just one single breakthrough can turn a tiny unknown company into an absolute giant, creating massive opportunities, if you know where to look.
All right, so here's our game plan. First up, we're going to explore the incredible and frankly staggering demand that's fueling this whole biotech boom. Then, we'll look at a huge problem that big pharma is facing, one they're desperate to solve. After that, we'll see how these two sides are coming together in partnerships that unlock just enormous value. And finally, and this is the best part, I'm going to give you a hunting guide to help you find these exciting opportunities for yourself.
So why is this sector so supercharged with potential right now? Well, it all boils down to a simple but, pretty tough fact. We are in desperate and growing need of new medical breakthroughs. And just to really understand the scale here, we're going to focus on just one disease, cancer.
Let's just start with this number and let it sink in. Back in 2010, the American Cancer Society reported nearly 1.6 million new cancer diagnoses in the U.S. alone. I mean, think about that. That works out to a life lost to cancer every single minute of every single day. The scale is just immense.
But here's the thing. This massive problem, it's actually getting bigger. Projections show a 45% jump in new cases by 2030, hitting about 2.3 million every year. And a huge reason for that is simply our aging population. In fact, the number of diagnoses among the elderly in 2030 is expected to be the same as the total number of cases we see today. It's a huge wave that's coming.
And look, this isn't just a U.S. problem, not by a long shot. This is a global crisis. To give you some perspective, the World Health Organization was reporting 12.7 million new cases worldwide all the way back in 2008. They projected it would hit 20 million by 2020, and the numbers have just kept climbing. It highlights this urgent worldwide need for new treatments.
So when you have a problem this huge, what follows? Money. A ton of money. The National Cancer Institute projected that spending on just cancer treatment would blow past $158 billion a year by 2020. And this is where the opportunity really snaps into focus. All of that cash is being funneled directly into these innovative companies on the front lines, the ones actually fighting the disease.
Now, you'd think the giant pharmaceutical companies, the household names, would have this all under control, right? But the truth is, they're facing a massive crisis of their own. And kind of ironically, their big problem creates the absolute perfect opportunity for all these smaller, more nimble companies. It's all about something called the patent cliff. Think about it like this. A drug like Lipitor, right? It was a cash cow for Pfizer, bringing in billions and billions of dollars. But then its patent expired. And suddenly, generic versions flooded the market, and that massive river of cash slowed down to a trickle. Well, this exact scenario is happening to blockbuster drugs all across the industry.
and it's leaving these giants scrambling to find the next big thing.
And this slide just lays it out perfectly. On one hand, you've got Big Pharma. They are swimming in cash, they have massive resources, but their biggest products are dying off, and their own R&D can be slow and bureaucratic. Then, on the other hand, you have these small biotechs. They're fast, they're hungry, they're sitting on absolutely groundbreaking technology, but they're burning through cash like crazy. You see where this is going, right? It's a symbiotic relationship, a perfect match.
And when these two forces team up, it's just this incredible win-win-win scenario. The small company gets the capital it desperately needs to keep the lights on and keep developing its tech. The big company gets a fresh, innovative drug to put in its pipeline. Investors, they can see some absolutely incredible returns. And, most importantly, patients get access to new and hopefully life-saving treatments. Everybody wins.
Okay, so that's the theory, right? It sounds good on paper, but does it actually work in the real world? Oh yeah, it does. These partnerships are happening all the time, and they are generating staggering results. So let's stop talking theory and look at some real-world examples.
Now, before we jump into our first case study, we just need to get our heads around the science a little bit. A lot of researchers believe that one of the keys to fighting cancer lies in something called cell signaling. Think of it like the internal communications network for your body's cells, like a complex text messaging system. But when those signals get crossed or a bad message gets sent over and over, that's when cells can start growing out of control. So being able to fix these broken pathways, well, it's a total game changer.
And here is a perfect example in action. There was a small company, Ariat Pharmaceuticals, and they had some really promising tech in this whole cell signaling space. Well, the giant, Merck, took notice. And the deal they struck was, wow, get this, $75 million up front just to walk in the door. Then over $500 million more in potential milestone payments as the drug progressed. And on top of all that, royalties on future sales. For a small company, a deal like this isn't just a big deal, it's everything.
So what does a deal like that actually do for investors? Well, just look at these charts. Regeneron's partnership with Sanofi-Aventis helped send its stock from under $6 a share to over $60. Incyte partnered with Novartis, and its stock went from just $2 to over $20. We are not talking about small gains here. These are the kinds of returns that can change your life, and they're fueled by this exact partnership strategy.
And you know, it's really important to remember this isn't all just about developing new pills. The same wave of innovation is completely transforming medical devices. We're talking about everything from robotic surgical tools to advanced joint replacements. It's these small, innovative companies that are shaking up the field, and that creates just as big of an opportunity for investors.
Let me show you a great example. A company called Trans1. They decided to tackle spinal fusion surgery, which is a major operation that can cost anywhere from $50,000 to $100,000. Now, as you can see here, the old way was, well, it was brutal. We're talking huge incisions, muscles getting cut, organs literally being moved out of the way. Trans1 came up with a new method that required just a 1-inch incision. I mean, just imagine the difference for the patient. A faster, way less painful recovery. And for insurance companies, lower costs. It's a win-win.
So what happens when a company develops a procedure that's less expensive, less invasive, and better for the patient? Well, the market notices. Big time. Trans1's stock shot up over 70% in less than a year. It's a perfect case study of how a technical breakthrough in medical devices can create that same kind of explosive growth we see with new drugs.
All right, this is the part you've been waiting for. The potential here is obviously massive. So the big question is, how can you find these game-changing companies before they hit the mainstream? In this final section, I'm going to give you a practical guide to start your search.
Here are 4 really powerful tips to get you started. First, you're going to become an insider by using the FDA's own website to track new drug approvals. Second, you're going to follow the smart money. And by that I mean, see what the top biotech mutual funds are buying. Third, use your own network. Talk to doctors and pharmacists you know. And fourth, and this one's so simple, start with what's right in front of you. Look in your own medicine cabinet.
Okay, let's break that first one down. The FDA's website, fda.gov. I know it can seem super complicated and overwhelming, but you're just looking for a few key signals. What you want to do is search for a company's press releases about positive phase 3 trial results. That's the final stage of human testing before approval. And even better, look for a new drug application filing, or an NDA. That's a huge milestone. It's the company basically telling the world, hey, we think we're at the finish line.
And remember,
And this is probably my favorite tip. You do not have to be a molecular biologist to win at this. You can let the experts do the heavy lifting for you. Look up the big health and biotech funds, like the T. Rowe Price Health Sciences Fund or the Fidelity Select Biotechnology Portfolio. Their top holdings are public information. These are companies that whole teams of PhDs and financial analysts have already researched and vetted. It's a fantastic place to start building your own watch list.
And so that really brings us to our final thought. A single new drug, a single new medical device, it has the power to take a company from complete obscurity to being the next big thing, sending its stock price to absolutely unbelievable heights. The key is finding those small companies with great science and strong partnerships. And the wild thing is, the opportunities are out there right now, many of them trading for just single-digit prices. So the only question left is, will you be the one to find them?
Welcome. So, are you on the hunt for that next big investment opportunity? You know, the one that everyone else is missing. Well, what if I told you it might be hiding in plain sight, in a low-price stock from a country you've maybe never even thought about? Today, we're going to break down a really powerful strategy for finding these global growth stories way before they hit the mainstream.
So let me ask you this, right off the bat. Is your portfolio kind of stuck at home? I mean, if you're only investing in your own country's stocks, the source material we're digging into today makes a really strong case that you could be missing out on some of the absolute biggest and fastest growing stories happening on the entire planet. So here's the core idea. You know that emotional roller coaster of fear and greed that creates bargain stocks right here? Well, guess what? That's happening all over the world now. And the best part is, thanks to modern tech, you don't need to be some Wall Street genius to find these hidden gems anymore. They are literally just a click away. Now, to understand where the next massive fortunes are going to be made, we actually have to take a little trip back in time. The whole strategy we're about to unpack is based on this incredible parallel, the idea that today's emerging markets look a lot like the US did during its own explosive industrial revolution.
Okay, this slide right here, this is the key to the whole thing. Just think about it for a second. 100 years ago, if you'd had the foresight to invest in the companies building America's railroads, its steel mills, its power grids, my gosh, you would have made an absolute fortune. Well, today, that exact same story is playing out, right now, in emerging economies. It just has a modern twist. This historical parallel, it's basically our roadmap. And this quote just nails it. As countries develop, they tend to follow a pretty predictable path. That creates this huge demand for new infrastructure and brand new services. And for investors who can see that pattern taking shape early on, the rewards can be just enormous. All right, enough with the theory. Let's see this idea in action with some real-world examples. First stop, China. This is where the author of our source material saw a little glimpse of America's industrial past, but in the country's fast-expanding railroad network. The company that really stood out was the Guangshen Railway. Now, this wasn't just any railroad. It was a critical artery for commerce. It connected the manufacturing heartland of mainland China with the global money hub of Hong Kong. You can really think of it as the economic lifeblood for a region that was just absolutely booming. So, what was the big opportunity here? Well, it was like a perfect storm of economic forces all coming together. You had China in the middle of this historic boom, and for the first time ever, a new middle class was starting to pop up with money to spend. Guangshen Railway was just perfectly placed to cash in on this brand new desire for travel and tourism. And the result? Whoa, the stock doubled in just 18 months. And that was as the rest of the world was just starting to wake up to the whole China growth story. This is a perfect example of the power of getting in on a massive trend before it's obvious to everybody. Before it's all over the news. So, that China story was all about a new consumer class starting to take shape. Now let's look at a different angle of the exact same playbook, investing in the fundamental building blocks of a growing economy. And for that, our next stop is Mexico. Meet Cemex. This was a company that was, quite literally, building the future. I'm talking about the stuff for skyscrapers in Mexico City, highways in Eastern Europe, and even the housing boom in the US. Cemex was providing the essential ingredients, the concrete and cement, for a truly global construction boom. This whole investment idea was born from a super simple observation. Cranes everywhere. The author of our source saw them all over the skyline in Mexico and just knew that a massive construction boom was kicking off. And the thing is, it wasn't just in Mexico. It was a global thing, and Cemex was right in the middle of all of it. And the results were, well, pretty spectacular. For every dollar somebody put into CEMEX back in 2003, they got back more than $3 just a few years later. It's a really powerful example of how betting on the physical growth of the world can lead to some incredible returns.
But here's where the story gets really, really interesting, and this is such a critical lesson. When the 2008 financial crisis hit, CEMEX got absolutely crushed. The stock just fell off a cliff. But the story didn't end there. As the world started to pick itself back up, so did CEMEX. This just goes to show you that these kinds of investments can be a bumpy ride, for sure, but that long-term trend of global development is like a powerful wind at your back.
Okay, so we've seen how investing in physical stuff like railroads and cement can really pay off. Now let's switch gears and look at the digital side of this whole equation. Our final case study takes us all the way to New Zealand, where a different kind of infrastructure created a pretty unique opportunity.
So this is Telecom New Zealand. And this company had what was basically a monopoly on the entire country's communications system. They'd already done all the hard work and spent all the money to build out a nationwide network. Now they were just ready to sit back and collect the rewards.
So what was the big play here? Well, New Zealand was actually lagging a bit behind the rest of the developed world in cell phone use, which meant there was a huge runway for growth. But here's the kicker. While you were waiting for all that growth to happen, the company was paying you a very handsome 6% dividend every single year. It was the ultimate get-paid-to-wait kind of investment.
And yep, the strategy worked like a charm. The stock doubled in value, and on top of that, investors collected that fat dividend check every year along the way. It's just a great reminder that not all growth stories are these explosive, overnight things. Sometimes, slow and steady really does win the race.
All right, we've seen the proof, right? China, Mexico, New Zealand, 3 totally different countries, 3 different industries, but the same underlying pattern every time. So now, let's get to the playbook. I'm going to show you a simple 2-step framework you can use to find these kinds of opportunities anywhere in the world.
What's so great about the author's strategy is how simple it is. It's a 2-step process that just follows the natural flow of money in an economy that's growing. First, you invest in the foundation. Then, you invest in the boom that comes right after.
This slide just lays it all out perfectly. Step 1, it's all about investing in the companies that are building the absolute essential infrastructure of a modern economy. Think CEMEX building the roads or Telecom New Zealand laying the communication lines. Then, step 2 is about investing in the companies that cater to the brand new middle class that pops up because of all that development. And that's exactly where a company like Guangshen Railway comes into play.
And really, this is the big takeaway. By just thinking globally and looking for these simple, powerful trends, you can uncover these amazing investment opportunities that most people just completely miss. It's all about being one step ahead of the crowd and finding value where nobody else is even looking.
Now sure, the examples we just walked through are from 2 decades ago, but the playbook itself is as relevant today as it ever was. So the real question for you is, where in the world is the next industrial revolution happening right now? Which countries are laying the groundwork for a new era of growth? And where is the next generation of consumers about to come online? The answers to those questions, well, that could be the key to your next great investment.
All right, let's dive right in. Have you ever been told that the secret to finding a great stock is to just look for a low PE ratio? Well, today we're going to completely blow that idea up. We're jumping into Chapter 8 of the Little Book of Big Profits from Small Stocks to find a much, much smarter way to spot those breakout companies, the ones that are still flying under Wall Street's radar.
So here's our game plan. First, we're going to unlearn some old bad habits. Then, we're going to take apart 2 of the most popular stock metrics out there, the PE and the PEG ratios. After that, we'll introduce a really powerful new way of thinking, talk about the mindset you need, and finally, we'll give you a brand new toolkit to put all this into action. And you know, this first step, it might just be the most important one. If you want to find those hidden gems that can deliver massive returns, you first have to be willing to forget some of the most common advice you've ever heard about picking stocks.
This quote right here really nails what we're trying to do today. We're not just looking for stocks, we're on the hunt for new facts, for new ways of seeing things that everybody else has totally missed. That's how you get a real edge in the market.
The big idea from the book is that for the kinds of smaller stocks we're hunting, the old rulebook just gets it wrong. So what I'm asking you to do is just for a little while, set aside everything you think you know about stock analysis. We're going to build a new foundation from the ground up. Okay, so the very first thing we have to just toss out the window is this idea of the efficient market theory. You know, the theory that says all the important information is already baked into a stock's price.
Now, for giant companies that have thousands of analysts watching them, maybe there's some truth to it. But for the small, low-price stocks we're talking about, no way. Absolutely not. These companies are basically ignored by Wall Street, and that right there is where our opportunity is hiding. All right, let's tackle our first big myth, and this is a huge one. It's a metric that's treated like gospel by so many investors. I'm talking about the price-to-earnings ratio, and I'm going to show you why it's often a dangerous trap. So, what is the PE ratio? It's simple, right? It just compares a company's stock price to its earnings. And the conventional wisdom, the thing you hear everywhere, is that a low PE means a stock is cheap, a good deal. A high PE means it's expensive. Sounds logical enough. But here's the billion-dollar question. Does that simple rule of thumb actually work when it really counts? You know, right before a stock is about to make a huge move? Let's look at a real-world example and see for ourselves. Okay, look at this. This chart just flips everything upside down. Check out Ford in 1999. Their earnings were at a peak and the PE ratio was a cheap 9. So if you followed the low PE rule, you would have bought in right before the stock tanked. Now, let's jump to 2002. The economy was struggling, Ford's earnings were in the gutter, and the PE ratio was a scary-looking 88. It looked incredibly expensive. The low PE investor would have been running in the other direction, and they would have missed the stock nearly doubling in the next year. The takeaway here is just crystal clear. For a lot of companies, especially ones that go through cycles, a low PE often means that earnings are at their peak, and so is the stock price. And a high PE can actually signal that earnings have bottomed out and the stock is about to turn around. It's the complete opposite of what most people believe. Okay, so if the PE ratio is a trap, what about its fancier cousin, the PEG ratio? You know, the one that factors in growth. Surely that's got to be better, right? Well, let's put it to the test. The PEG ratio tries to fix the PE's problem by looking at the PE relative to how fast the company is growing its earnings. And yeah, it's often seen as a more sophisticated tool. But, and this is a huge but, it has a massive blind spot. Let's take Starbucks after they had a really rough patch. These kinds of companies, these fallen angels, are exactly what we're looking for. Great businesses that have stumbled. But at that moment, their earnings had just fallen off a cliff. Their recent growth rate was basically 0 or even negative. So if you ran a stock screen looking for a good PEG ratio, Starbucks wouldn't have even shown up on the list. You would have completely missed an incredible turnaround story, all because the PEG ratio was looking in the rearview mirror. So we've spent some time tearing down the old rules. Now it's time to build up the new ones. This is where we shift our entire perspective, moving away from static, snapshot numbers and towards something much more powerful, direction and momentum. This is it. This is the core philosophy, the phrase I want you to remember. Better beats good. It's so simple, but it changes everything. What it means is that we care way less about whether a number is good right now and far, far more about whether that number is getting better. The direction of the trend is what matters, not the absolute level. To really see this in action, let's look at another metric, return on equity, or ROE. Basically, it measures how profitable a company is with the money its shareholders have invested, and traditionally, everyone says a higher number is better. Now, this example with the homebuilder Toll Brothers back in 2006 is just perfect. If you took a static snapshot, you'd see their ROE was 20%. And you'd think, wow, 20%, that's a good number. This is a solid company. But if you looked at the direction, you'd see a totally different story. That good 20% was actually down by 1/3 from the year before. The trend was pointing straight down. That wasn't a good sign. It was a massive red flag that things were getting worse, fast. And it was a warning that the housing market was in big trouble. And that right there is the key. Are profit margins getting wider? Is the company paying down its debt? Is revenue growth picking up speed? See, a company with a bad ROE that's improving from 2% to 4% could be a much, much better investment than a company with a good ROE that's falling from 20% to 15%. We're hunting for the story of improvement. Now, this whole better beats good philosophy isn't just about using new metrics. It really requires a totally different mindset. It's about making a conscious decision to step away from the crowd and think for yourself. Look, it's simple. If you use the same tools as everybody else and you think the same way as everybody else, you're going to get the same results as everybody else. And those results are usually pretty average. We're not here for average. We're hunting for those stocks that can deliver huge, life-changing profits. And you just don't find those by following the herd. So the big question is, how do you actually do this? Where do you find the real story? Let's get practical and equip you with the right tools for the job. Your most important tools are not going to be some fancy stock screener or what some analyst on TV says. Nope, they're the official reports that every public company has to file, the quarterly 10Q and the annual 10K. And the best part, they're totally free for everyone on the SEC's website. Your mission is to go straight to the source, read these documents, and find the clues of improvement that Wall Street is too lazy to look for. So here's your action plan boiled down to 3 simple steps. 1. Access the reports. Go get the latest 10Q and 10K. 2. Forget. Make a conscious effort to ignore those misleading static numbers like the PE ratio. And 3. Analyze. Dig into those reports, compare this quarter to the last one, this year to the last one, and look for those crucial signs that things are getting better. So I'll leave you with this one final thought to guide you. The next time you look at a company's financials, ask yourself, am I just looking at a bunch of numbers? Or am I looking for the story those numbers are trying to tell me? Because finding that story of improvement, is where you'll find the truly amazing investments. Trying to find that next big stock can feel impossible, like you're searching for a needle in a giant haystack. But what if you had a map? Well, in this explainer, we're going to cut through all the noise of those hot tips and start thinking like a real financial detective. We're going to build a playbook step by step to help you uncover some really compelling opportunities, simply by knowing exactly where to look and, more importantly, what to look for. So this is the million-dollar question, right? It always feels like by the time you hear about a great company, all the big money has already been made. But here's the thing. There's a systematic process, a repeatable workflow that the pros use to get a leg up on the crowd. And that's exactly what we're going to build right here, right now. Your own personal research playbook. All right. Every good investigation needs a clear path. So first, we'll examine the hard evidence, the financial numbers. Then we're going to go interrogate the primary source, the company itself. After that, we'll look for clues out in the market, consult with some expert witnesses, and finally, we'll uncover your secret weapon in this whole investigation. Let's get started. Okay, our investigation starts right at the scene of the crime, the balance sheet. Before we get all caught up in an exciting story about a new product or some visionary CEO, we have to check the company's financial vitals. This first step, it's all about making sure the foundation is solid. The very first test is for financial strength, and this metric, it's basically our lie detector. It's built on that simple, old-school wisdom that you should own at least as much as you owe. This ratio tells you, plain and simple, how much of the company is built on a solid foundation of its own money versus a much riskier foundation of debt. So, here it is, the key takeaway. We're looking for a debt-to-total capitalization ratio of 50% or less. Now, why is this so important? Well, it's because when a company has less debt, it just has more flexibility. It's way, way less likely to go bankrupt if the economy hits a rough patch. Think of it like a powerful safety filter that instantly weeds out all those financially fragile companies. Now this is a crucial mindset shift for any investor. See, when we look at a balance sheet and see assets, buildings, factories, tech, we think strength, but a really savvy investigator sees a ticking clock. This quote is a reminder that every single one of those assets eventually becomes an expense. Buildings need repairs, machines get old, software becomes obsolete. The real question a detective asks is, what future costs are hiding in plain sight? Next up, we got to dig into the company's official filings, their annual 10K or their quarterly 10Q reports. This is where you hunt for the hidden clues. If an auditor gives a qualified opinion, that is a massive red flag. It means they have serious doubts about the numbers. A sudden change in auditors? Also a huge warning sign. And you want to be really wary of phrases like going concern or these complex off-balance sheet deals, because those are often just sophisticated ways to hide debt and risk. All right, so we've established the company is financially stable. Now it's time to hear their side of the story. The numbers, they tell us about the past, but we need to understand the plan for the future. So we're going straight to the source to understand their strategy, their plans, and how they see the world. This might be the single most valuable and underutilized tool for individual investors. Seriously, just about every publicly traded company has an investor relations or IR section on their website. It's an absolute treasure trove of press releases, financial data, and most importantly, the presentations they give to Wall Street. And finding this stuff is incredibly simple. You don't need some secret password. Just follow these 3 steps. You're looking for that webcasts and presentations link. This is where management lays out their entire strategy for professional analysts, and you get a front row seat to the exact same information, totally free. And to see just how powerful this is, check out this real-world example from a Wendy's presentation. In one single document, an investor could learn about new products, confirm their strong financial position, see plans to return cash to shareholders, understand a huge strategic shift like selling off Arby's, and even get a roadmap for future growth. I mean, this isn't just data, it's the company's own story about its future. Okay, so we've analyzed the books and we've heard the company's story. Our case is definitely getting stronger. But what does the rest of the market think? Now it's time to look for some external clues by following the actions of what they call the smart money. Now, you don't need to be a technical charting wizard for this, but the price chart can tell a really compelling story. Is the stock price moving higher on a big increase in trading volume? That can be a huge tell, a sign that large institutions, like hedge funds, are quietly building a position. A breakout to a new high suggests that momentum is really building. It's all about using the chart as an indicator of market sentiment. An even more direct signal is to watch what the corporate insiders, the executives and directors, are doing with their own money. And there's a world of difference between selling and buying. See, an insider might sell stock for dozens of perfectly good reasons, to buy a house, pay for college, or just to diversify their portfolio. But insider buying? That's a whole different story. And this is the absolute crucial point. Insiders only buy their own company's stock on the open market for one single reason. They believe it's a fantastic investment. They have the ultimate inside track, and when they put their own hard-earned cash on the line, it sends an incredibly powerful message of confidence about where the company is headed. Okay, so at this point in our investigation, we have a solid foundation, a compelling story, and supporting evidence from the market. But, every good detective consults with experts to confirm their theory. And the great news is, you don't need a Wall Street budget to get your hands on professional-grade research. Here it is, your free research toolkit. ValueLine is a legendary service praised by investing icons like Warren Buffett and Peter Lynch. Standard & Poor's and Morningstar provide these fantastic in-depth reports that you can often get for free through your discount brokerage account. And hey, even a site like Yahoo Finance gives you instant access to analyst estimates, so you can see what the pros think without getting a sales pitch. We've now covered the numbers, the company's story, market signals, and expert opinions. But we've saved the most unique and potentially the most powerful source of information for last. This is your true secret weapon, the people you already know. It's so easy to assume that an expert network is something only for those big-shot hedge fund managers. But you'd be wrong. You have an incredibly powerful intelligence-gathering network all around you, hiding in plain sight. Just think about the people you talk to every single week. Your friend Sam, who manages a phone store, he knows exactly which smartphones are flying off the shelves. Your cousin Betsy, a pharmaceutical rep, she hears direct feedback from doctors about which new drugs are really gaining traction. Joe, the car dealer, knows which models have a 6-month waiting list, and Mary, the bank manager, has a real-time pulse on the local economy. This is priceless, on-the-ground intelligence that you will never, ever find in a Wall Street report. So we've gathered all the evidence, we've interviewed all the witnesses, we've examined this case from every single angle. Now it's time to put it all together and assemble our final, actionable research playbook. This is your playbook. Number 1, start with a rock-solid balance sheet, less than 50% debt. 2, read the fine print for any of those auditor red flags. 3, go straight to the source, the company's own investor presentations. 4, follow the smart money, especially when insiders are buying. 5, use that free expert research to validate your findings. And finally, number 6, never ever underestimate the power of your own network. You now have the tools and the framework of a financial detective. The only thing left to do is to begin your first investigation. So that just leaves one final question. Who is the first expert in your network, your friend, your relative, your neighbor, that you're going to talk to this week? Your next great idea is probably a lot closer than you think. Okay, so let's get right into it. We all spend a ton of time trying to figure out what stocks to buy, right? But what about the other side of that trade? Honestly, knowing when to sell, that's probably one of the hardest, most emotional parts of investing. So today, we are going to break down a really clear framework for making that exact decision
And this isn't just a tough spot for beginners. I mean, from the pros on Wall Street to someone just starting out, this is a universal challenge. It's that moment where your cold, hard strategy goes head to head with your gut feelings, and getting it right can make all the difference for your portfolio.
I absolutely love this phrase. A stock bought right is half sold. It basically means if you do your homework and buy a great company at a good price, you've already won half the battle. But that's only half the story, isn't it? The other half, the part we're really going to focus on, is about having a system for when to get out, especially when things don't go exactly the way you planned.
And that brings us right to the heart of the problem. Selling forces you to look in the mirror and face your own analysis. You have to ask, was I wrong? Did I miss something? It's tough. Our egos can really get in the way. But you have to remember, not even the best professional golfer shoots a perfect round every single time. And no investor, no one, picks only winners.
So this is a really crucial mindset shift. Selling a stock for a loss isn't some kind of failure. Far from it. It's actually a fundamental skill you need to have. Once you start treating it as just a normal, necessary part of the process, that's when you go from just surviving in the market to actually thrive it. All right, let's get into the nitty-gritty, and we'll start with the part nobody likes to talk about. Your stock is down. What do you do? Do you panic? Do you just hope it comes back? Well, the source material here argues for a much, much more structured approach than that. And honestly, it all comes down to this one simple question. This is the most important thing you have to ask yourself with total honesty when one of your stocks is in the red. Am I wrong, or am I just early? Because the answer to that question is going to dictate your every next move. It separates a temporary dip from a real, fundamental problem with the company. So how do you actually figure that out? Well, the author gives us this clear 3-step diagnostic. First, you have to go back to the source. Read all the company's filings, all the news releases that have come out since you first bought the stock. Second, you're not just looking for anything, you're hunting for material changes, things that really truly impact the core business. And third, you watch the insiders, the execs. What are they doing with their own money? They know the company better than anyone. Now, what's so helpful here is how we can define those material changes. We're not talking about small stuff. We're talking about serious red flags that could totally destroy your original reason for buying the stock. Like, look at this list. Has the company suddenly taken on a mountain of new debt? Is their cash burn speeding up, meaning they're just blowing through money faster than ever? These are the tough, fact-based questions you have to force yourself to answer. And the advice here is crystal clear. If you do your homework and find that the story has fundamentally changed for the worse, you sell, period. You don't hang around hoping for a miraculous recovery. You don't wait to get back to even. You just accept that the facts on the ground have changed and you get out. There's an old Wall Street saying for a reason, your first loss is almost always your best loss. And this right here really drives home that third step. Watching what the insiders are doing is so critical. If the CEO and other executives are buying up more shares, even as the price is falling, that is a huge vote of confidence. It's a powerful sign that your original idea might still be right, that you might just be early. But on the flip side, if you see a whole bunch of insiders consistently selling their shares, that is a massive warning sign. Remember, they have a front row seat. They see problems long before they ever show up on an earnings report. Let's use a real-world example from the author to see how this plays out. They had to ask that key question, were we wrong or were we just early? Now, the initial reason for buying L&L Energy was solid. It was a play on China's massive demand for coal. But then the facts changed. Big concerns started popping up about the accuracy of their financial statements. And that's a classic material negative change. No matter how great the story about coal was, if you can't trust the numbers, you can't own the stock. So they sold. They took the loss. It was the disciplined, correct move to make. Okay, enough of that doom and gloom. Let's switch gears and talk about the much happier side of this whole thing, knowing when to cash in a winner. This might sound like the easy parts, but believe me, it can be just as tricky. Just like with a losing stock, the decision to sell a winner comes down to checking the facts again. This slide gives us a fantastic little scorecard. Are the fundamentals, like revenue and profits, still getting stronger? Is the stock's price action healthy? Is it making new highs on good volume? If the answer is yes, then hey, you might just want to let that winner keep on running. But if you start to see signs of a slowdown or the company suddenly needs to raise a bunch of cash, it might be time to ring the register.
Now, for anyone who's a little more on the conservative side, the author suggests this great strategy called scaling out. It's super simple. After a stock has a huge run, let's say it doubles, you sell just enough shares to get your original investment back. From that moment on, you are, as they say, playing with house money. It's an awesome way to lock in your profit and take all the risk off the table while still letting the rest of your shares ride for free.
So, up until now, we've mostly been talking about signals coming directly from the company. But sometimes the reason to sell has less to do with the business itself and a whole lot more to do with the market, and specifically with crowd psychology.
And this classic quote from Warren Buffett just nails the idea perfectly. Think about it. When you first bought your stock, chances are it was undiscovered, maybe even a little bit hated. But now, all the analysts are upgrading it, it's all over financial news, everybody loves it. Well, that cherry consensus often means the best, easiest money has already been made. This is the fundamental, contrarian question you have to ask yourself. Stock prices go up because new buyers come in and push the price higher. So, if all the potential buyers are already in, if everyone who's ever going to love the stock already owns it, who's left to buy from you at a higher price? It's a simple question, but it's a powerful one. It might mean the stock's big run is nearing its end. And here's a very specific, actionable signal for you. When that little undiscovered company you found years ago gets big enough to be added to a major index like the S&P 500, that's often a fantastic time to sell. Why? Because the stock is no longer undiscovered. When a company joins an index, all the funds that track that index are forced to buy shares, no matter the price. This creates this huge artificial wave of demand that can give you the perfect exit price. Okay, now we get to what the author calls their absolute favorite reason to sell a stock. It's the one situation where the decision is totally made for you, and it's almost always a huge win. Just think about it for a second. What's a small, fast-growing, profitable company? It's the perfect meal for a much bigger fish. See, huge companies need to show growth, and it's often way cheaper and faster for them to just buy a smaller competitor than to try and build that business from scratch. Private equity firms are always on the hunt for these kinds of companies too. And here is the best part. When another company decides it wants to buy your company, they can't just pay whatever the stock price is that day. They have to offer a premium, often 20, 30, even 40% higher to convince all the shareholders to sell. That means you get a for sale at a fantastic price. It's really the ultimate proof that your original analysis was right on the money.
This old Wall Street saying just sums up the whole philosophy perfectly. The dogs, in this case, are all the hungry buyers, the big institutions, the index funds, the company that wants to acquire your stock. When they are absolutely desperate to buy what you own and they're willing to pay a premium for it, you let them have it. You sell into that strength.
So if we were to boil this entire explainer down to just one single idea, this would be it. Getting selling right has almost nothing to do with luck or timing the market perfectly or your emotions. It's all about having a disciplined, repeatable process where you are constantly checking your original idea against the cold, hard facts, whether those facts are good or bad. And that leaves us with this final question to think about. Imagine you're in that good problem scenario. Your stock has had a huge run. The news is fantastic. Everybody loves it. Based on everything we've just talked about, what's your next move? Would you hold on? Would you scale out some of your position? Or would you sell it all? There's no single right answer, of course, but just thinking about your answer, that's going to tell you a lot about how you approach the discipline of selling from now on.
All right, let's talk about low-price stocks. You know the ones? The single-digit tickers that people either think are a golden ticket or a ticking time bomb. So which is it? Are they a minefield or a gold mine? Well, the answer is they can be both. In this explainer, we're going to show you how to tell the difference. We'll learn how to sidestep the predators and maybe, just maybe, find those hidden gems that Wall Street is too afraid to touch. Let's get into it.
And this quote right here, this is the key to the whole thing. It flips the script on what most people think about risk. The idea is that the price tag on a stock doesn't really tell you how risky it is. The real story, the answers you're looking for, they're buried in the numbers, in the financial statements. A healthy $5 stock could be way safer than a shaky $30 stock that's about to fall off a cliff.
So here's our game plan. First, we're going to blow up Wall Street's biggest myth about stock prices. Then we'll meet the real villains behind the infamous pump and dump and see how their scams have gone digital. Most importantly, we'll talk about your best defense, look at some sneaky hidden costs you need to know about, and finally, we'll wrap it all up by revealing what the real risk actually is.
Okay, Let's dive right into the deep end and tackle this huge misconception. It's this idea that a low price automatically means high risk. It's a simple rule of thumb that a lot of people follow, but as we're about to see, it's not just wrong, it can make you miss out on some incredible opportunities.
On one hand, you have the common belief, cheap stock, big gamble. Easy enough to remember, right? But the reality is so much more nuanced. A company's actual health. Can it pay its bills? Is it actually making money? That's what truly determines the risk. The share price is just one data point. The company's books tell the entire story.
And here's the coolest part. This mistake that Wall Street makes, it actually opens a door for you. Because so many big institutional investors won't even look at a stock below a certain price, they create a blind spot. And for anyone willing to roll up their sleeves and do a little digging, that blind spot is exactly where the opportunities are hiding.
So if the price itself isn't the big scary monster, then what is? Well, this corner of the market definitely has a dark side, and it attracts some real predators. It's time to talk about the true danger you need to watch out for. The classic pump and dump.
You've seen the movies, right? Boiler Room, The Wolf of Wall Street. Hollywood just loves these stories. But here's the thing, they aren't just fantasy. They're based on very real, very destructive scams that have wiped out countless investors. This isn't just a movie plot, it's a real-world threat.
The scheme is called a pump and dump, and it's pretty much exactly what it sounds like. It's a type of fraud where scammers use hype and lies to artificially inflate or pump up a stock's price. Then, once the price is sky high, they sell or dump all their shares, leaving everyone else holding the bag.
So here's the four-step playbook. First, the scammers quietly load up on millions of shares of some worthless company, paying just pennies. Step 2, the hype machine kicks on. You get flooded with emails and social media posts screaming about the next big thing or some revolutionary breakthrough. Third, unsuspecting people start buying in, and all that demand drives the price way up. And finally, the dump. The scammers sell everything at the top, the price collapses, and all that money from honest investors goes right into their pockets.
Now, these scams didn't just vanish, they evolved. The old-school boiler room with guys screaming into phones has been replaced by the internet. And that makes it easier, faster, and cheaper than ever for these scammers to reach millions of potential victims.
I bet you've seen one of these. You open your inbox, and there it is, a secret stock tip about some tiny company you've never heard of that's supposedly about to go to the moon. It sounds way too good to be true, promising you'll get rich quick. So, what do?
The answer is beautiful in its simplicity. Just hit delete. Seriously, the source material says that 99% of the time, that's your single most powerful weapon. If a stock tip comes out of the blue from someone you don't know, it's not an opportunity. It's a trap.
Okay, so dodging scams is one part of the equation, but the other part is finding the legit companies. And your best defense against the bad guys and your best tool for finding the good guys are the exact same thing, doing your homework.
This is the million-dollar question, isn't it? A lot of stocks are cheap for a very good reason. The company is failing. So your job as an investor is to be a detective, to figure out how to separate a real turnaround story from a business that's just circling the drain.
So here are some huge red flags to look for. First, the basics. Can the company pay its bills? Look at their balance sheet. Second, search for any whiff of fraud. If it reminds you of disasters like Enron or WorldCom, run. And finally, if a company is in bankruptcy, pay close attention to who's buying the stock. If the insiders and the big-shot hedge funds aren't touching it with a 10-foot pole, that's a massive warning sign for you to stay far, far away.
All right, let's say you've dodged the scams and found a company that actually looks solid. You're not quite done yet. There are some practical, kind of hidden costs that can sneak up and eat away at your returns if you aren't paying attention.
This table lays it out pretty clearly. For low-price stocks, brokers might charge you a higher commission. They might charge you more to borrow on margin, if they even let you do it at all. But the sneakiest cost is often the bid-ask spread. For a big, popular stock, that spread might be just a penny. But for a little-known $1 stock, the spread can be much wider, which means you're losing a bigger chunk of your money every single time you buy or sell.
So, here's the pro move. Before you even think about hitting buy, always check that bid-ask spread. And to protect yourself, use what are called limit orders. This lets you set the exact maximum price you're willing to pay or the minimum price you're willing to sell for. It gives you control and stops those hidden costs from taking a bite out of your profits.
Okay, so let's bring this all home. We've busted the myths, we've met the villains, and we've talked strategy.
What this all boils down to is a massive shift in how you think about risk.
For most of Wall Street, the perceived risk is that little number next to the ticker symbol. But the actual risk, the thing that will really get you into trouble, is a lack of research. The danger isn't buying a cheap stock, it's buying any stock without knowing what you're doing just because you got a hot tip.
There's a great line from the source material that just says it all. If your Uncle Fred were a great stock picker, he wouldn't need to borrow $100 from you. The point is, finding real value takes real work. It's not about listening to tips from friends or strange emails. It's about doing your own research.
And that's really the big takeaway. The fear of low-priced stocks is mostly just a myth. The real dangers, the scams, the bad businesses, those are things you can actually spot and avoid if you know what you're looking for. The power is completely in your hands. So the only question left is, now that you know what to look for, where is your research going to lead you?
You ever get that feeling that when it comes to investing, you're just playing a game that's, well, completely rigged? Like you're an amateur athlete stepping onto a field full of super soldiers? It's a common feeling. But today, we're going to dive into an explainer that pretty much hands you a whole new rulebook. We're breaking down a strategy that's built from the ground up for the individual investor. Focusing on a little corner of the market where you can actually have the home field advantage, not the big institutions.
And the author kicks things off with a truth that, let's be honest, hits pretty close to home for a lot of us. Trying to outsmart the Wall Street pros on a stock like, say, IBM, it's like challenging a Formula One car to a 100-meter dash. It's just not going to happen. I mean, think about it. These behemoth companies have armies of analysts covering their every move. Their shares are traded by algorithms faster than you can blink. Any bit of news is priced into the stock in milliseconds. For you and me, trying to find an edge there is frankly a total waste of time.
Okay, so that brings us to the most important question, right? If you can't beat them on their home turf, what do? Well, you change the battlefield. And the answer, the real core of this entire strategy, is to go where the giants can't, or more accurately, where they won't go. It's all about finding those hidden opportunities in the shadows, way outside the blinding spotlight of Wall Street.
Okay, so here's how we're going to break this down. First up, we'll dig into why these low-priced stocks even have an advantage in the first place. Then we'll get into the right mindset you need, becoming what's called an optimistic cynic. After that, we'll look at the actual research playbook. Then we'll talk portfolio building, and finally, we'll put all the pieces together to see the path to those big profits.
All right, first section. Let's get right into let's call it the physics of this whole thing. Why does this strategy of focusing on smaller, low-priced stocks actually work? Is it some kind of magic? No. It's really just simple market mechanics, the kind that create a huge inefficiency that you, the individual, can actually take advantage of.
And this slide really shows you why. Think about it like this. Trying to get the stock price of a massive $25 billion company to double? That's like trying to turn an aircraft carrier on a dime. It takes an unbelievable amount of money and effort. But a $250 million company, that's a speedboat. A little bit of good news, a relatively small flood of new investment, and that thing can take off like a rocket. It's got the potential for that explosive kind of growth the giants just can't deliver anymore.
So here's the secret sauce. Your whole advantage comes down to timing and using Wall Street's own rules against them. See, a lot of these huge funds literally have rules that say they can't buy these small stocks. Sometimes they're even forced to sell a perfectly good company just because its stock price fell below a certain level. And what does that do? It creates a sale, an artificial discount. So you get to be the smart one, stepping in to buy it cheap. And then you just wait. You wait for the company to grow and get back on their radar, and then you can sell it to them when they all come rushing back in.
Okay, so having a great strategy is one thing, but it's totally useless if you don't have the right mindset to actually use it. And this next part is key. It's not about being a bull or a bear, always optimistic or always pessimistic. It's about building a much more sophisticated psychological toolkit.
And the author has this brilliant term for it, the optimistic cynic. I love this. Think of it like you have two people living in your head. The optimist is that part of you that believes in the future, that knows long-term things tend to get better, economies grow, and good companies win. But the cynic is your inner detective, wears a trench coat, trusts absolutely no one, and needs to see cold, hard proof for every single claim. To really win at this, you need both of them working together.
Now, having this dual mindset completely changes the game when the market goes crazy. You know the scene. The headlines are screaming crash, everybody's running for the exits, pure panic in the streets.
The average investor freaks out. But the optimistic cynic, they take a deep breath and they ask a totally different and way more powerful question.
And here's where the optimist in you takes the microphone. They ask, is the world really ending? Because let's face it, unless you truly believe it's the end of civilization as we know it, history tells us the answer is always no. And that one question completely reframes the situation. A terrifying crash becomes what the author calls an inventory creation event. I mean, how great is that? It's not the apocalypse, it's a massive Black Friday sale on great companies, and you're there with your shopping list ready to go.
But hold on, the optimist doesn't just get to go on a wild shopping spree, not without the cynic's approval. This is your built-in defense system. The cynic is that voice that hears a hot stock tip and immediately goes, that's interesting. Now I'm going to spend the next 10 hours trying to poke holes in this and prove it's a terrible idea. That skepticism, that discipline, that's what protects you from hype, from scams, and even from your own wishful thinking. It's what makes sure you only buy things you genuinely understand.
Okay, so the mindset is locked in. You're an optimistic cynic, ready to find opportunity when there's blood in the streets, and ready to question everything. Awesome. Now let's get tactical. Let's talk about the actual research playbook, how you tell the difference between a hidden gem and a piece of junk. And it all starts with this piece of wisdom from the legendary Charlie Munger. Think about it. In a world of algorithms and flashy news clips, the one true advantage that you can have, the one that never goes out of style, is deep knowledge. So the process doesn't start with some fancy stock screener. It starts with reading. We're talking annual reports, company filings, industry magazines. You have to actually earn your insights.
Now, the good news is the author breaks this down into a really simple 3-step process. You don't have to be a math genius for this. You just have to be a good investigator. Step 1, you read the official documents, the filings. Step 2, you check out the story they're telling the public on their website. And step 3, maybe the most important, you investigate what the insiders, the people running the company, are doing with their own money.
And within those steps, you're basically hunting for clues. For example, the footnotes in those big annual reports. That's where companies love to hide the bad news. A nasty lawsuit, a change in how they do their accounting. That's a potential red flag right there. But on the flip side, what if you see a bunch of top executives buying their own company stock on the open market with their own cash? Well, that's one of the loudest buy signals you can possibly get. They know more than we do, and they're putting their money where their mouth is. That tells you a lot.
All right, finding one stock that could go up 10 times is an amazing feeling. But we're not just treasure hunting here. We're trying to build wealth for the long term. And that means building a fortress, a portfolio that can stand up to whatever the market decides to throw at it.
And the number one rule here is one you've probably heard before, but it's absolutely critical. Do not put all your eggs in one basket. It's just common sense. If you put every penny you have into, say, tech stocks, and the tech sector takes a nosedive, you're toast. But if you spread your bets across different industries, a little tech, some healthcare, maybe some financial companies, you protect yourself. One area might be having a bad year, but another could be doing great, and it all balances out.
And we can take this a step further. This is a really clever way to think about it. It's not just about being in different industries. It's about understanding how they relate to each other. So take oil prices. If oil prices shoot up, that's great news for an oil company, right? Their profits go up. But who does it hurt? Airline companies. Their biggest expense is fuel. So by owning both, you've created a natural hedge. No matter what oil prices do, one part of your portfolio is likely to benefit. It's like building a balanced ecosystem.
Okay, let's bring this home. We've talked about the strategy of going where the giants aren't. We've talked about adopting that optimistic cynic mindset. We've got over how to build a smart, resilient portfolio. Now for the last piece of the puzzle, connecting all of this hard work to real, life-changing results.
And the author makes this incredibly motivating point that really puts everything into perspective. After all this talk about process and diversification and research, in this specific corner of the market, sometimes all it takes is one. Just one. One great company that you found, you did the homework on, and you got into before the rest of the world caught on. One big winner. And this is so important. This isn't just about watching numbers go up on a screen. The money you can make from this kind of success, that's the tool you can use to achieve your biggest goals in life. We're talking about paying for your kids' college education. We're talking about that dream vacation or even that dream home. Those hours you spend digging through financial reports could literally translate into paying off your mortgage early. That's the real endgame here.
Now, to help you get off the ground, the author doesn't just give you the theory, he actually gives you a practical starting point. He provides 3 of his own hand-picked stock recommendations. Think of these as your first case studies.
real companies you can use to practice your new research skills and see how this whole process works in the real world.
And of course, the learning doesn't stop when this is over. Investing is a journey, right? So he also provides a companion website. It's a place where you can find more tools, more ideas, and just keep sharpening your skills for the long haul.
So that's where we land. We've shown you the playbook. We've walked you through the strategy, the mindset, and the research. The advantage for individual investors like you is real. It's out there. The tools are now in your hands. So the only question left is, are you ready to go find it?
Have you ever picked up a book, maybe one about something fast-moving, like the stock market, and thought, is this information still good? I mean, a book is a snapshot in time, right? But some topics need to be live. Well, today, we're diving into a really simple but kind of brilliant piece of tech that builds a bridge between that printed page and real-time data. So here's our game plan. First up, we'll talk about that bridge to real-time info. Then we're going to decode what a QR code actually is. After that, I'll walk you through the super simple 3-step scan. We'll also cover the digital alternative, for when things don't go as planned. And finally, we'll check out some other cool stuff from the author. Okay, let's get right into it. Our first section is all about this idea of a bridge to real time and how we can connect a good old-fashioned physical book to the live, ever-changing world of online information. I mean, this is the big question, isn't it? The second a book gets printed, that's it. The information is locked in. And for a novel, that's totally fine. But for a book about stock tips, that info could be old news by the time you even get it home. So how on earth do you keep that content fresh and valuable? Well, that's the exact problem the author wanted to solve. And the answer to that problem leads us straight into our next section. It's time for us to decode the QR code. We're going to get to know what the source material calls the next generation barcode. So what exactly is this thing? Well, a QR code, and that stands for quick response code, is basically a barcode on steroids. You know those regular barcodes on everything you buy? They hold just a tiny bit of info, usually a product ID. A QR code, with all its little black and white squares, can hold way, way more data, like a full website address, for example. And this little guy right here is the key. The author calls it a quick and simple way for you to access my real-time stock recommendations instantly. Just think of it like a secret door on the page that takes you straight to the live info you're after. It's pretty cool. Okay, so we know what it is and what it does. But how do you actually use it? Does it require some sort of technical wizardry? Nope, not at all. Let's jump into our next section and break down just how easy it is with the 3-step scan. Step 1 is about as easy as it gets. You just need that little device most of us have in our pockets anyway. Yep, just grab your cell phone or a tablet or really any mobile device that has a camera on it. That camera is your magic wand here. All right, step 2 is getting the right software. Now, for a lot of you with newer phones, the scanner is probably already built right into your camera app. You just open the camera, point it, and boom. If that doesn't work, no sweat. Just head over to your device's app store, type in QR scanner, and you'll find a ton of free options you can download in seconds. And now for the final step, the action. Open up your camera or that scanner app you just downloaded and just point your device at the QR code in the book. You don't even have to take a picture or anything. Just hover your camera over it so the whole code is in the frame. And that's it. The whole thing happens automatically. Your phone sees the pattern, reads the code in just a second or two, and just like the name Quick Response suggests, it instantly pulls up the information. In this case, it zips you right over to the author's latest recommendations. Simple as that. Now, that all sounds great in a perfect world, but we all know that technology can be a little fussy sometimes, right? What if your phone's dead, or the lighting is terrible, or maybe you just don't have a smartphone? Well, that brings us to a really important backup plan, the digital alternative. Look, these are totally fair questions, and the beauty of this whole system is that it was designed with these potential hiccups in mind. The goal is to make sure this valuable information is available to everybody, not just people with the latest tech in their hands. So here's the bottom line. Don't you worry. If for any reason at all you can't scan that QR code, you are not going to miss out. Every single piece of that updated real-time information is also available online for anyone to access. And here is that backup plan. You can just open up a web browser on your computer, your laptop, any device really, and type in this website, www.bigprofitsfromsmallstocks.com. It's the foolproof, manual way to get to the exact same content. Okay, so now that you're a pro at pulling live info from a physical book, let's zoom out a little bit. In this last section, we're going to take a quick look at some other resources from the author, Hilary Kramer. If you're enjoying her approach to investing, you should know that she also has 3 other investing newsletters. And as you can see from the logos here, each one kind of targets a different strategy in the market. Let's just run through them real quick. You've got Game Changers, which, as the name implies, focuses on companies that are shaking up their industries. Then there's Breakout Stocks under $5, which is all about finding those hidden gems with huge growth potential. And finally, High Octane Stocks, for those interested in faster-paced trades and options. So if any of those sound like they're up your alley, or if you just want to dig a little deeper into the author's work, the source points you to this website. You can head over to www.gamechangerstocks.com to check out sample issues and get all the details. So as we wrap this up, let's just quickly hit the main takeaways. Number 1, QR codes are this amazing, simple bridge between a physical book and live data online. Number 2, using them is a piece of cake. It's just a simple 3-step process. And number 3, and this is so important, there's always a backup plan. That website alternative means no one gets left behind. You know, using a QR code to link a book to a website is such a simple but really powerful idea. It really gets you thinking, what's next? We're already seeing things like augmented reality make cereal boxes come to life. So I'll leave you with this question to chew on. What do you think is the next big thing, the next frontier for merging our physical and digital worlds?